We look deep into the heart of housing demand today on the Gray Report with data from Fannie Mae on what's driving the increasing importance of the home compared to 10 years ago. We'll look into demographic trends that help us chart a path for housing demand into the future, and we'll look at persistent housing affordability challenges and how low-income tax credits housing fits into the housing affordability picture as a whole. Then we've also got some updates on loan delinquencies and potential loan distress as CredIQ finds that multifamily distress volumes have hit a 12-year high. So whether you're a multifamily investor, a industry insider, or you're just looking to learn more of the week's most important news, research, and reports from the multifamily industry, housing, and the economy, you are in the right place with the Gray Report. Let's get started. Hi, we're back today at the Gray Report with a special guest, Addison Lubert, who is the Senior Acquisitions and Asset Analyst at Gray Capital. He's been here at the Gray Report before, but always like him. It's good to see you back. How you doing? What has happened in multifamily in your own professional life this past week? Anything exciting? How do you think things are going? What's going to happen?
Can't predict the future. I think if I could, probably still wouldn't be holding the same.
Yeah. Be a little more successful. Maybe.
Yeah. But no, I mean, things have come to a little bit of a snag on the acquisitions front in terms of where new opportunities are coming out. But that's also a little bit specific to just kind of where we're at now as a firm in the sense of where our buy box is.
Yeah.
If you're kind of still in the 40s, 50s, 60s, 70s asset class, you're seeing a little bit more movement and your opportunities are pretty solid. Cap rates are higher.
Yeah.
And
for older properties.
Yeah.
Yeah.
Cap rates are higher for your older properties, and just kind of the competition you're facing is a lot different, depending on who you are.
Yeah.
It's a pretty advantageous setup. You're not really dealing with institutional players or REITs or anything like that. Mm-hmm. So. If you're in that place, there's a great opportunity at the present. I would say for where we're at with our buy box, the opportunity is still great in terms of where asset pricing is. You're just seeing a lot less stuff come to market in terms of transactions. So,
when did you see the transactions fall off, or did they just stay low throughout 2024 and into 2025?
2024 definitely picked up compared to 23.
Okay.
And I think 2024, I don't know how many people necessarily, I can't say it was a lot of people that were forced into sales by their lenders or any situation like that. But you always, on any given year, have people that are just a part of funds, and it's a part of their business plan or part of how they operate where they need to transact. So you always see those transactions. But I think as 24 went on, you probably saw some people that either executed their business plan on the deal and they wanted out, or they were looking at probably a refinance or just some sort of capital event where they knew they were going to need to move on, and they went with that route. Then I think into 2025, where there's been a little bit of a slowdown, is I think a lot of people were kind of just holding off because they thought there'd be a better debt scenario.
Yeah. Things would get better.
Rates would be better, or
and have things gotten better? Have rates gotten better?
Treasuries have not really helped out people, but I think there's a little bit of the hope going on there in terms of thinking where they.
Powell's going to have more cuts, or are you thinking about 10-year Treasury rates?
No, I think people are still, for the time being, holding out hope that their picture is going to get a little bit better. But I think
that their own operation is going to get better.
Right.
Yeah.
And I think as we get into 2025, transaction volume is going to pick up because some lenders are going to start forcing some people of. Yeah. There's only so many assets in your portfolio that you can save that are on this debt timeline. Mm-hmm. I think that's kind of where things are at. I also think there's a little bit of just a lot of slowdown you're seeing in the economy, and just outside of real estate is happening now, where some people are just kind of putting a pause just to kind of see where the broader economic picture shakes out. So
Yeah.
right now it's just kind of a moment of pause and uncertainty, unfortunately.
Yeah, that's something that that has been discussed a little bit in the office and on the Gray Report before is the increased capital calls that we are noticing anecdotally. I haven't seen any kind of comprehensive report about it or any kind of hard data on it, but it would be interesting to know if this is widespread or if this is just anecdotal. Now, Gray Capital must remind you, we have not done a capital call, but this is something, in speaking with some investors there where it's like, yeah, this is happening. The other shops, other outfits, they're issuing these capital calls and they're making it difficult.
Well, and where you get really concerned is if they can't invest in any more deals because they have to contribute.
Yeah, that's our frustration.
Capital,
That is our number one frustration. It's like, don't give the money to the capital call, give it to us and help us with our project. But
Right.
but that's that's our own. That's kind of the onus is on us to be that good salesman there because it's tough. You don't want to. There is the idea of throwing good money after bad, but there's also like you don't want. There's also you got to go against the sunk cost fallacy a little bit too. And so we'll have to see about that. I do think that the economic uncertainty that you've said, is probably also coloring investor confidence a little. Last week we talked about how there was improving investor confidence, and lately the latest numbers is just a little bit of a hitch, whether it's consumer or investor. The past few months, past quarter or so, it's just been a hitch. Still roughly positive, but clearly there has been an inflection point, and the inflection point was like Q1, or is Q1 rather. Now for this, we can just kind of get into the articles. Although I do want to note what you did note. You did talk about loan maturities and something from Credit IQ that I noted at the top of the show was we are hitting this 12-year high for loan delinquency, loan distress. How they define it is we'll get into in just a second because I think some people have a technical distress definition, and then there are things that you kind of colloquially refer to as distress, and then we can look up the official definition if we want to make sure we're getting it right. But my point is on these, whether you're calling it delinquency, distress, troubles in the loan space for multifamily borrowers, those troubles are long-term trends, and they're not going to just jump up and jump down. Very rarely do they. And so we have been for the past year or two in a long-term steady increase that I think that we've got some momentum that may continue. So we may be in another period of rising loan delinquencies, and this probably is not just a blip that's going to go away. So that's what I'll say, and we'll get to the data here as the show continues. That's a little teaser. I like that. We don't have sports as the teaser, but we do have something that we can throw people. All right, so Fannie Mae, what is driving the increasing importance that consumers place on their homes? This is an really interesting report. It is 66 pages long, and it's going to be hard. Impossible to cover it all, yes. There is going to be some stuff that I leave out, but I do think that the overall questions that they have are fairly similar throughout. So they're like, what are you looking for when you're looking for a home? Are you looking for your home's location? Is that what's made the home more important to you? Is it a sense of security? Is it entertainment, leisure time? Is it your access to outdoor living? Or is it your home as a financial asset? Now, I believe when I first clicked on this, I'm like, well, yeah, home's more important because it's worth more. In the past 5 years, home values have gone up like 50%. So that'd be enough for me to say, yeah, it's about 50% more important than it used to be. But this gets into things that are beyond that. I don't want to get into that circular logic too, because if a home's more important, you will pay for it, and then it's more important because you pay for it. But beyond that, it does break it down into these things that people like. Do you want walkability, or do you want your home for rental income? So there's these different factors here. I am fighting the urge again to say it's worth more money, but that's fine. I do like this throwback that they have early on to the kind of pre-pandemic idea of what people wanted from their home. They talk about I'm sorry, they say in the post-pandemic world, many consumers are using their homes in different ways than they previously did. These changes can include adapting a home to accommodate lifestyle changes, functional needs for work, schooling, and hobbies, or multi-generational living so that families can live under the same roof. Well, just starting with this lifestyle changes, I liked that they said lifestyle changes such as a desire or need to grow food and raise animals, which I like. It's a kind of leading off with some interesting details. And I'll admit this makes me feel a little bit sheltered, a little out of it. I feel like a city boy because I wanted to be able to grow a vegetable garden in my house, but I do too much shade. I can't do it. I think chicken coops also great, but I can't really imagine that it's a deal breaker for most people if they can't grow their food at home. I do like this quote. There's some. I wish I had the page numbers here, but I'm going to go to the quote.
I think where the chickens become the deal breaker for the people moving into the neighborhood, not.
Yeah, exactly. And if there's like a rooster in the neighborhood, there's someone that we know is dealing with that with that specifically. Now this is a quote from a renter who says, "I have sowed a garden. I have learned my way around the city with this home as my center. I have made memories in this home. I like my neighbors." I think that's some poetry. First of all, I wasn't expecting that, and I am floored. Put that in some, put some end lines in there, maybe some artistic dashes. That's really good. Okay. Sorry, I gotta calm myself. As rare as this wordplay is, it's also kind of less common to find renters placing more value in general on the home. The real jumps here were among homeowners who thought that the homes were more important, and comparatively, renters did not say that their home was as important. So home ownership more important, less important. So renters, I'm looking to see how it jumped, and they have this data broken down across a lot of different pages, and that was actually one small frustration is I'd like to see a little bit more in time, but it appears that their comparison points in this survey were 2015 and Q3 2024. So that's just a reminder here. However, so I am sure that there are plenty of people where growing food at home is a top priority. Some people grow food and sell it at home. That's great. I think, though, that it is page 18, for instance, forces me to consider the conflation of gardening non-foods like flowers, maybe your ornamental bushes, or like a hosta, and the food type gardening, which may need more sun and space. Like I said, I wish I had a vegetable garden, not enough sun for that. I think so 60% want a garden space, but really only 46% would be willing to pay more for it. So that's there's a little bit of a bifurcation there. Also, 61% are willing to pay a little bit more for outdoor living spaces, and 18% of them. So again, here we go. 60%, that's really important. But then you scroll down to, all right, do you actually use it? It's 18%. So that's a gap of, let's say, 42%. 42% of optimism there that you say that you're going to grow it, but instead all you're really doing is mowing your lawn. And now you're like, that's a lot of work, and that's fine. But let's go to something a little bit more utilitarian, something I can identify with. And I do want to say that all of this stuff about vegetable gardens and stuff, it is purely out of jealousy. I wish that I could do it, but that's fine. I'm not going to move. I'm not going to move houses because of it. But onto more functional needs, which is for work, schooling, and hobbies. I think that this one really checks out, and it is. There was this story this was the actual real story that was told and retold in the early moments of the pandemic to for a couple years. Really was like, oh, now everyone's going back to the home. They are increased in the apartment market. The unit size increased because maybe we said, oh, maybe there's a Zoom room now. Remember Zoom room? There was that big moment, right, where a bunch of people were kind of staying at home, decorating a house, remodeling a little bit, but there was definite, from a work standpoint, you were doing more in your home, and therefore it was more valuable because it was supplanting the office. There was something that I could understand there. Yeah, domestic vibes very strong. And let's look at page 13 to see how people then use their house here. So this is a functional changes of the home. The number one functional change here was working remotely from the home at 25%. 19% then using home for hobby. Growing food to eat or gardening, that's again, there's that 18%. Learning remotely from home, 13%. Multi-generational, 10%, and so on. So 55% made functional changes to their home or lifestyle at home. 45% were unchanged. I don't know if I believe this because everyone changes, right? I don't know. Functional changes though. And some of these smaller ones are keeping animals that provide food or income at 5%. That's frankly a little bit larger than I thought, but that's okay. Multi-generational living so that family members can live together under one roof. Now, that may seem that is less identifiable as like a major narrative, but I do remember during the beginning of the pandemic when everyone was kind of moving to their hometown or moving in with their parents or something like that. So that was a very real trend. And I don't know if it has continued as before or if this is a long-term trend. Again, I would love to see how things track over time here. But a decent reminder then of all of these factors that precipitated from the upheaval of the pandemic. Is there anything, and also I think, breaking down these things that connect you to the home, whether it is, maybe some people do like their home because that's where their chickens live. But I think breaking them down, you get to some stuff that is perfectly applicable to renters. For instance, I'm harping so much about gardening, but it seems like more people want to be a gardener if they are renters than if. So renters, and I'm thinking they're imagining a home, right? Like, oh wow, when I get a home, I'm gonna have a vegetable garden. And homeowners, less so, is like when I have my next home, it's gonna be a vegetable garden. So this little O here on the 67% for renters that value that space, that means it's statistically significant, more so than homeowners. So this is 67% compared to 56% of owners. So a lot of these renters want a garden. Does that mean that an apartment community should have space for, maybe not a garden, but like we talked about how we could build in like yards for people if it was a first floor, that we could like fence off an area so that someone could have like a small yard that was outdoors on the first floor of an apartment building. That's something I think that's kind of cool. But we'll see. And this may also be a bunch of renters not yet being homeowners and saying like, oh yeah, it's really important. And then the homeowners are like, yeah, well, I thought it was important, but now all I do is mow the lawn. So I don't know, there's like reality and not, but there are plenty of people that are good at gardening, and one day that will be me. I'm going to figure it out. I gotta figure out a spot with enough sunlight, but. So that is, it's worth really checking out all 66 pages of this. There's really a lot here, and they break it down in a bunch of different ways, and so it's not just the stuff that I've said. They talk about how important closer proximity to workplace is, closer proximity to public transportation. And I said before, for renters, walkability is a lot more of a factor, and that makes I think that makes sense to me because, well, maybe they're public transportation more among the renters. They're probably more likely to not have a car versus homeowners, but that's another thing. So I think some of these are also, income levels too. You have to factor in what are the demographics we're looking at. Maybe younger people are more renters and they want more room for hobbies versus homeowners. There's just different factors. They all break it down here, and I was really happy to see this report, and so we'll have that in the notes here. All right, so moving on.
I think the biggest or the most significant piece to that, if you go to the anecdotes of why things are more important or what they were valuing.
Mm-hmm.
The last one, owning our house outright has protected us from the dramatic increase in home prices and rental costs since 2020. Feels like being in a safe, solid bunker in a war zone. I think the majority of the people in this, or statistically speaking, but I think the people in here that are feeling as if their homes are more important to them, like they can say it's a garden or whatever.
Yep.
That's the biggest.
Oh, yeah,
I would have to think that it's
totally
out the biggest, especially if they bought in 2020 where everything's gone up but my mortgage payment is the same.
Yeah.
Or if they locked into 2018, 2019, they refinance, like something, just anything that they got out of it, because that is a big thing. And I also think, I mean, I can speak this as somebody that went from an apartment complex to renting a house. You're not as, yes, you are paying attention to the rent and what that does, but I'm not paying for a parking space. I'm not paying for different fees that come with your apartment complexes. So I think that is just if anybody is feeling like really bullish about home ownership, I think that has to be just the biggest, is they have fixed rate financing, advantageous financing.
And you see that in home sales numbers too, that this is what they're acting on.
And I think the last part really speaks to it. And they say it feels like being in a safe, solid bunker in a war zone when everything around you is getting more and more expensive, and you're hearing about how unaffordable it is to rent or to now buy a home. And you were able to do that 4 years ago, 4 or 5 years ago.
Yeah.
And your rates have stayed the same. You're not.
Oh yeah, you're completely insulated. Yeah.
So I think that's.
You're buying before home prices and before rates went up significantly. Then you could talk about chickens all you want. I'm 2% interested in my home because of chickens that I imaginarily have. That's me.
So I think I would say that's the biggest, and then I also wonder how many of these are renters that it falls along what you said of people that have been living in a studio apartment for way too long, or a one bed, or just in a cramped situation, and they fall in love with the idea of, I'm going to have a vegetable garden.
Yeah.
I think there's plenty of people, especially my age, that fall in love with the aspects of home ownership, and that all goes away when you have a roof problem, and that's
called
all
home.
you.
That's home grownership.
Yeah.
I learned that early on. I like this other quote too. Housing costs around me have risen, and I cannot afford to leave. That's a renter.
I would imagine your house would become more important to you if that's the reality you're facing.
Yeah, or this is a renter, and it's like, this is where I am, There's nothing, that's the flip side, to the people that have enjoyed these price increases are the renters that don't necessarily enjoy them at all. And rent has gone up a little less than home prices, but rent has gone up. You can't ignore that. So
now, one thing, and this has been touched on by different people throughout that just kind of cover this. It's wild when they start these conversations off by still doing post-pandemic.
Yeah,
because you're kind of like in that groove of like, okay, post-pandemic. We're at the 5-year mark.
Yeah.
Since the pandemic took off. I wonder how much of this is people that how many people in the survey, they got into the housing market for the first time in 2020, and they hit it big by like getting into affordable situation with a low rate and everything that we mentioned. They don't really have a frame of reference to say, okay, had I done this in 2015, but then also when I enter this back in, like what's their range of data points? Because if you got in at you got in at the right time, but you don't have anything to reference back to, and all you hear is it's expensive. That has to create some sort of like we kind of have to stay here, because we can't really afford it.
And they do break it down from like mortgage borrowers to outright owners, and you can look and see, so for people 65 plus. My home offers a sense of security in uncertain times. 18% of 65 plus say that's more than the 15% of people, maybe first-time home buyers at 35 to 44. So I'm not really positive. I do think though that your major point about the real factor here is that home prices used to be the home prices have gone up so dramatically that people feel like they've got all these kind of unrealized gains, or at least like there will be such a negative to moving that the home is kind of a sanctuary. So. Yeah. So let's move on to some of these more demographic forces that are driving housing demand. So we looked at the factors. What about some of the trends that you can use to look ahead a little bit and see specifically what's driving multifamily demand? And this is just a very quick add to last week's conversation, which talked about how short-term data becomes a little bit less useful in the context of these economic transitions that are really quick, and how maybe long-term trends like demographic trends can be useful. Last week, the specific example was Marcus and Millichap used medical office, and they talked about the aging boomer generation said medical office demand is going to increase. Let's look at these long-term demands with the boomers that are aging. And this week, they're talking about multifamily and the millennial generation. Millennials are getting older, as you can see here. And the average age is 34. The median age of marriage is 29. And traditionally, you buy that house and you live that American dream. But home prices are not going up. Let's skip to the part where it has that graph there. Home prices are not going up. And that age is getting older. So let's look. See the home price. The home payment is now at $3,098 when it used to be in 2020 closer to what 1.5 or I'm sorry, like 1.6. Let's see, 1,600. Now it's at 3,000. So that's almost double the home payment, I guess. And rent has actually not changed that much at all. Really, from 1.4 to 1.8. So 4,000 versus. I don't know the percentage change, but you really see it in this graph here where the rent growth bar looks very flat, the rent growth line looks very flat, and the line that represents increasing monthly home payments has sharply risen. I'm actually pretty surprised that it's gone up that much. Let's say it's gone up by 1.6 to 3. That is, it's almost double. That's crazy. But the other thing that's happening is, as a result, then the average age at which people make their first home purchase has gotten older because home prices are increasing so much more. Wow, marriage at 29, home purchase almost 10 years later at 38. That is meaning, as a result, and this is something that we've heard a lot, is that people are remaining renters. This is a tangible data point that's a little bit easier for me to grasp than just the general idea. And again, we're waiting on that data that will say what the clear difference is when home prices when the gap between rents and home prices goes up this much. How much does that drive apartments? But it seems like it has, and maybe the data of like extending the age of your first home purchase is one that's like probably the most objective at this point. So yeah, really interesting. A comment on last week's video asked why job growth numbers for Austin, Texas were not positively correlated with rent growth, and it's because supply was gone up so much. Home builders are not building enough here, and that's what the kind of end of this video is. And John Chang's calling for stronger rental demand in the next 5 years, because no matter if it's the single-family home market or the multifamily market, there's not going to be enough building that happens either this year or maybe the years to come. But I'll have to keep an eye out and see what the longer-term trends are for starts and completions and what the apartment and single-family home supply is going to look like. But it doesn't look like we're building enough. And that's where I wanted to, just to return to that comment on last week's video. And the reason why job growth numbers are less positively correlated with rent growth in Austin, Texas, which has very strong job growth numbers, is because they had an enormous amount of supply, and supply just overtook it as the top primary influence of rent growth. But that may return to there may be a greater balance in the future.
Yeah, I think something that kind of gets a little bit lost in this is, specifically with millennials, I'm sure it probably applies to a little bit of the generation above, but millennials on down to Gen Z and really generations for the foreseeable future, unless they get this under control. There are other monthly payments that are happening in addition to what would be a mortgage and rent check for the millennials, being largely student loans.
Yeah.
And especially as we reach a point where they're not able to afford the down payment and the interest rates are getting things to a point where combined with not being able to afford the down payment or putting down less of a down payment with rates,
Yeah.
that higher payment is just going to be too much to swallow when you're trying to pay off a student loan or whatever.
Yeah.
So yeah, I think that plays a big role. I don't have specific data to point to like how much of a role it plays, but I think that's like millennials, I would have to think, are kind of that first generation where it's like that's becoming too much of a burden for them, that they've had to push off some of the purchases that generations prior were really quick to make, or I shouldn't say really quick.
Yeah, because of the cost of higher education increasing so much quicker than wages.
Yeah.
Yeah.
So yeah, I think that's in addition to just housing supply and everything that is typically tracked. That's, I'm curious to see what role that plays moving forward.
Yeah, that's a good point.
I think it's only going to get worse.
Yeah, yeah, and that's ultimately what kind of where John Chang lands a little bit is like the housing supply shortage. The relative shortage is not going away anytime soon. And I was listening to another podcast earlier that talked about the same thing. It's like this is on everyone's mind, and no one is optimistic that we're going to get the housing supply that we need. It's funny because at the beginning of the year we were thinking that rates were going to be the thing that prevented building, and now we have questionable tariff and situation where that may, that's a drag, and this economic uncertainty that's also makes it difficult for builders. So it's a little bit more overdetermined than it used to be when it comes to the construction industry. Yeah. So wanted to have that kind of connect that these long-term forces with the more personal factors. So we're talking about the demographics as in general, these big groups, and then and I liked that tie-in with the individual focus of the that Fannie Mae survey on what really makes you interested in a home.
Well, but if we factor in the potential for just student debt payments. Mm-hmm. I wonder how much of a role that plays, going back to the previous survey where people are talking about their current place being more than fine for them, and how many people are pushing off that first home purchase because I know Dave Ramsey fans don't want to hear this, but how many people are thinking, I'm not really interested in making that jump to a higher monthly payment and getting a mortgage when I'm tired of taking public transportation to work every day. My current situation in my apartment or the house that I rent or whatever is just fine.
Yeah.
Instead of taking the train, I would finally like to have a car, or I would like to stop driving the car that I've had that's falling apart. Like to get a newer car or a better car.
Yeah.
And just kind of what purchases are now being pushed at, like, what are the purchases that normally either would not have taken place or they would have happened well before a home purchase, that now people are just saying, like, I'm going to push a home purchase back even further.
Yeah.
Because not to dwell on this, but like, yeah, I'm tired of taking the train every day.
That's a really good point. Yeah, yeah. And the fact that there's a little bit of there's a lot of a squeeze now is only reemphasizes how important each of those individual individual decisions can be. And like, if I didn't have a car but I was thinking about buying a house, I'd like the car.
Yeah.
And replace car with a lot of different things that you want. Maybe they're just making different decisions there. However, I think owning a home is still obviously something that a lot of people want. It's a goal for people, goal for a lot of renters, and we'll see how that shakes out, especially as the affordability challenges are making it more and more difficult for that to happen for people. And so this is as good of a segue as any to Yardi Matrix's National Affordable Housing Report for March 2025, specifically really talking about LIHTC housing, federal low-income housing tax credit program. Their point is that over the next decade, hundreds of thousands of multifamily units in the U.S. built via the low-income housing tax credit are reaching the end of their compliance periods. There is a 15-year period. I think that there is a 30-year extended use period. But ultimately, 520,000 units nationally will hit the end of their compliance periods from 2025 through 2038. At first, I wondered why they picked that 15-year or 13-year period, but we'll see in later. It's just because there's a little bit of a fall off after 2038. That being said, when these compliance periods end, owners have fulfilled the 15-year obligation of affordability compliance, and they are no longer at risk of losing their tax credits. And because of this, affordable housing stakeholders worry that they will be spending more resources maintaining the nation's stock of affordable housing and less on building additional units that are badly needed. The author of this report, Paul Fiorilla, really emphasizes that we're just talking right now about maintaining. We haven't even gotten to building more of them, and that would be interesting. And I'm Paul Fiorilla, you are invited to make an appearance on the Gray Report show, and I will bend over backwards to make that happen. But at any rate, I'm going to chase down why it'd be interesting to know the pressures of building more affordable units, because that's what a lot of people are talking about. Like, well, you can't kind of build it to be cheap unless you're in some of these LIHTC housing programs. The Class C properties are not usually the ones that were built last year. They're the ones that were built in the 70s or maybe even before then. There is an effect of, no matter what, if you're building more houses, it has a cascading effect where it makes apartments everywhere cheaper. But I'm wondering how quickly that happens, and I'm guessing that it doesn't happen instantly. There's probably a lag period before the market adjusts, and yeah.
There's a lag period, but there's also, just speaking from multifamily, there's newer and more advanced amenity packages that are coming with properties that were built this year, 2 years ago, 3 years ago, obviously, that are going to be way more advanced than what was built in the 60s, 70s, 80s, and thus it's going to cost more.
Yeah.
And so it's a combination of, on their own, do they pencil that you can get it up off the ground? And then at that point, that's where these tax credits or abatements or TIFs or whatever are going to have to come in for people to just say, okay, in some of these markets where the numbers pencil to justify development, but they're going to need some help to really move the needle and get something to work, even in the sense that they're not going to get to that amenity package, or they might not deliver exactly what new demand wants. So yeah, it's
not
a great spot to be in.
Yeah, it's not a great spot to be in, and I'm just thinking of, well, okay, if the problem is affordable housing, we need, and there's difference between the affordable housing space and the market rate housing space. I think there is some overlap, but I think there is more acute challenges to getting housing supply in the affordable housing space, and that may be the reason why some of the numbers for rent to income are different. If you're going to look at, for instance, and we will look at these, if you look at RealPage versus Moody's Analytics, what you're capturing, the market rate market is a little bit different, maybe a lot different, depending on what you're talking about, and they also talk about it. And to return to this Yardi Matrix report, they also talk about investors interested in buying a property at the end of compliance period. They say that for those that are interested in doing that, the property's condition is of paramount importance. Now, I think you may think this is interesting. I thought it was kind of interesting. Either exceptionally, what do they say here? Complications arise if the condition is either exceptionally good or poor, as the extreme raises the possibility of affordable decontrol. Properties in pristine condition might tempt value-add investors who would raise rents and turn the property into market rate units. More commonly, properties with expiring use periods have extensive capital expenditure needs that buyers must contend with. Essentially, it seems like they're saying, well, yes, most of them probably need some work to be done, whether it's maintenance, repairs, etc. But some of them, but like if it's too nice, then maybe they won't, maybe they won't extend, they won't choose to have them remain affordable housing. So there's like some things that would tempt if it's really nice, if it's not really nice. There's it's just kind of interesting how there are barriers to these to the continued maintenance, and how I would also say is like it takes work every year, and there is a finite period for these investors, and once that period comes, they've got to make that decision. It seems like some of these periods are 30 years, some are 15, but as Paul Fiorillo writes, we'll need to do more than just maintain. I need to find that quote here specifically.
While you're doing that,
Yeah.
to touch on the point that the article was making, where they were talking about the CapEx situation regarding these properties, one situation that you really don't want to find yourself in, just with multifamily properties in general, it's not awful, but it's a part of the value add space that is not the most advantageous, which is you're having to do a lot of non-revenue CapEx.
Yeah.
You put new asphalt on in the parking lots.
No one's going to pay more rent for that.
Exactly.
Yeah.
Now, there's a chance that you have the runway in the future from it, because keeping the curb appeal up, hopefully that continues to have people that drive by and take a look at your property from the outside. You would think and hope that that keeps them interested and it maintains your property's exterior appeal. But putting new roofs, new gutters, new siding, the siding I guess is a little bit different, but some of these things that you have to do to keep the property in good condition, these are things that you have to do, but you're not going to get money on.
Yeah.
But you kind of have to do them in the sense that not only do you need it for the property's current condition, but when you go to sell, the next buyer is going to say, well, I'm going to have to bring on, not only am I likely going to have to bring on, it would depend on their business plan, but not only am I going to have to bring on capital or face the reality of bringing on capital to do interior upgrades where I can get the money back, but now I got to fix the parking lot.
Yeah.
Now I got to fix the roofs. And that's an additional couple $1 million or whatever, depending on the scope of the project that I have to bring on, then I'm not going to get money back. And so, with those affordable properties, kind of as they mentioned, the cash flow isn't always going to be there to do that. So whenever we've looked at some of those affordable properties, where there would be still in compliance during a little bit of the hold period, or it's ending and it would likely end by the time, hypothetically, had we bought and got under contract, it's that reality of to actually get this upside that everybody's talking about and bring these rents up, I have to do these value add upgrades. But it does not matter what you do on the interior of these units when your outside's looking awful.
Yeah. Yeah.
But you have to bring on millions of dollars to fix the outside, and there's no guarantee of income, or I shouldn't say no guarantee, but you're not really going to. There's no rehab premium that you could charge people for fixing the parking lot.
Yeah, and I should have noted this at the start here. LIHTC, part of the rules for this affordable housing is that owners must put units, either part or whole, of the property, and they must open them up to rent at a certain percentage of median income, the area income, right?
Yeah.
And so that limits their ability. That may mean that it doesn't that they can't operate with, if they're pouring a lot of money into it. Basically, they're probably not going to take in enough with rents if their rents are reduced because of the requirement, and so they probably don't have as much money to make those improvements.
So a perfect example of how that works for the better was property right down the street from us, Westmont.
Yeah.
That was structured in a way where you were at 80% of AMI. So when you look at the rent roll, or at least how the property
Average median income, AMI?
Right. Okay. You have your lease rents, and then you have your where you can take your lease rents to meet the market.
Yeah.
But then they had the average median income limits. Well, the AMI limits were significantly above market.
Yeah.
There's no way that you're ever, unless things really take off, which at 2022, where rates and stuff were headed, it wasn't exactly going to be the case.
Yeah.
On top of new supply and everything coming on. But if you looked at where the AMI was, there's no way you're going to achieve it.
Yeah.
So the owner operator of that
Okay. Yeah.
is going to benefit from the sense that you're getting a tax abatement, or you're getting some sort of incentive through your taxes to run that property, but you're not restricted in any way because the AMI limits are well above what you're going to achieve just by trying to get your units to market.
Yeah. Yeah.
And it's always going to be, shouldn't say always, but you're always going to be chasing market rents. It's
Yeah.
just kind of how if things play out for you well. But yeah, there is that general concern of you're capping me at the rents, and if AMI goes down or stays stagnant,
Yeah, they don't have, and
but
again,
but expenses and everything are going up, then you're in a bad situation pretty quickly.
yeah, yeah. So that was pretty much the emphasis there, is that given all this difficulties that we've said about continuing to maintain these affordable housing and keeping them kind of operating for their purpose, there's challenges there, but there's also, it seems like, the real important thing. Let's just build more of them, and we're not, and we'll have to see what kind of encouragement they can give, or I don't know if there's subsidies or anything like that, but housing affordability is still going to be an issue. Probably would still be an issue if we enact a bunch of new policies. So yeah, that's
No, but I mean, people don't want to hear it, but it does speak to the role, and in my opinion, a pretty beneficial role that state and local governments can have in addressing this issue. Because when you're taking a market that we're in right now where rates are high and you can't develop, those tax abatements or TIFs or whatever can start to help people make sense of a situation that they probably otherwise would have just looked away from.
Yeah.
Now, I'm not in the development world, so I'm sure with costs and a bunch of other things, just a simple tax abatement is not going to, it's not going to solve the problem tomorrow. But we've seen it take place in Indianapolis, and we've seen it take place in other markets where it helps bring along growth to a neighborhood where at that point in time, financing was not going to solve all of the problems, but giving somebody a 10, 15, 20, 25, 30-year tax abatement, however they were structuring it, got a lot of people to move and move quicker on things. And I don't foresee that need going away because as has been highlighted on this episode and plenty of other episodes and plenty of other publications, I don't know if you know this, we're drastically short on housing.
Yeah. And I've heard a lot.
We need people to build housing. They're not doing it.
I think that it can almost also be treated maybe even separately. Probably has to be included with the idea of zoning. I've heard, you'll get opposition for zoning in a single family neighborhood. They don't want apartments to go in.
Right.
But also, I've heard promising things maybe about zoning multifamily from commercial places, and that might open up a space. Rather than having to argue with the neighbors, it may be easier to move into a commercial area to move apartments in than to have all the neighbors.
Well, I mean, I know a big complaint that people have had in the city of Chicago, for example, is that this city, and I'd have to go in and verify some of these reports to get the full scope, but I mean, the city is sitting on lots that they could just zone immediately.
Yeah.
And go through that. So yeah, on top of, I mean, you and I, the NIAP event heard plenty of hurdles, not just from the construction, but that, you're going to somebody to buy land and they want their $3 million in 90 days, but the city you're dealing with can't tell you for another year or two whether this project's going to move forward. So a lot of those regulatory hurdles need to go, but
just to expand on that, there's all these stages of building something, from the land purchasing to the start, or to the permitting, to the start. There's barriers, difficulties, requirements that have to be done, and some of them are good. It's not like it's not like every regulation's bad. Let's get rid of them and now we can all be happy again.
Right.
Some of this is just illustrating the difficulties, because maybe you bought a plot of land and you actually learn, that dirt is contaminated because a laundromat used to be there. So it's just this is just hard. And anything that we can do, whether it's maybe smart deregulation or smart subsidies or support like LIHTC is probably encouraged, because it's not going away soon. And I think that this is something where, yeah, it's probably worth fighting for this. But I don't know. That's the goal.
It's I believe it was with Ezra Klein.
Mm-hmm.
I don't necessarily remember the congressman, but he had an interview, and a lot of this was centered around kind of an autopsy of the 2024 election, where things are headed in 2025. But he did kind of like a video op-ed interview with a Democratic congressman.
Mm-hmm.
Apologies, I don't remember the congressman's name, but the point that the congressman was getting at was specifically with, I mean, it applies in real estate, but it applies to kind of a lot of challenges that we're facing as a society. Of, if we look at real estate, well, why are people having a tough time affording rent, and why are people having a tough time stopping renting and starting the home ownership phase of their life? Yep. Exactly what we've mentioned. The rents are too expensive, or they can't get to the down payment, or they can't get to whatever. And then we get to the point of, okay, well then, first of all, we'll exercise the options of rent control or whatever that are not going to solve it. Mm-hmm. And then after that, there then goes to the point of, hey, we need to build more housing. We need to build more apartments. But the financing doesn't work. And we just kind of throw our hands up and say, all right, well, let's maybe wait for a year or two for rates to go down or what have you, kind of cut and run from the issue. And more or less what he was getting at is like, that line of thinking kind of has to stop. Like, we have to stop looking at the standard ways that we construct homes or construct apartments, and not remove regulation. But if we continue to look at everything based on stick build or by these ways of architecture or what have you, we're just going to hit the same problem. So with that, it's not just getting the TIF funding and getting the tax abatements to kind of make the construction pencil. I think there's also going to need to be a sense of like, well, we're going to have to start pulling as many levers as we can. We're going to start using different materials, or we have to think of just different ways to do this. And as much as we kind of laugh driving up College and seeing those Airbnbs or whatever that are built out of shipping containers.
Oh yeah. Well,
someone's using them.
Yeah. No, it's true. We are talking about the shipping container houses that are on College and Fall Creek. If you're in Indianapolis, go check them out.
Go stay in one. I'm sure they're great.
Yeah, I know. They look kind of cool. I do. I think that was all really really good points, and it just illustrates the size of the problem and how much, like, man, it was on both sides of the aisle during the 2024 presidential election. It's clearly a big important issue. So I'm expecting to see some effort, maybe by the government, to alleviate this affordable housing, because I wonder, because as it is right now, there are challenges, and I don't think that it will happen. Like, I don't think these houses are going to get built by themselves. So
they're not.
Yeah. So I really appreciated this report from Paul Fiorilla. Again, like, I'm probably going to follow up with him at some point to explain some of these trends and the relevance here of some of the data. But man, it's a big problem. It's not going away anytime soon, and LIHTC is a big part of it. So that's specifically relevant, I think, to a lot of the multifamily investors and syndicators and people in the multifamily industry. They're very familiar with LIHTC housing. So, and
to go along with the point, or kind of rehashing some of the points from the Ezra Klein interview and what we've talked about, there's also a good chance that by no means am I saying the LIHTC program needs to be scrapped. I'm also wondering if even that's a program that should have some reinvigoration of, is that the current way that's operating, or is the current way we're doing the subsidies, are we boxing people into a business plan, or boxing them into something that probably worked 10, 20 years ago, but it's not working now?
Yeah. I've seen
that could very well be going on.
Some of this conversation is being had around, I think, Ezra Klein has a new book called Abundance, and it's being discussed, especially the relevance of it in housing supply. And there is deregulation on one side. I think that there is some critiques to the abundance, to like his approach here. But like, I think it makes a lot of sense within the existing setup that we have for building housing. we got to find something that fits. And to try to rewrite everything, though, that may not get help as quickly enough. So I'm wondering where we can turn the dials up, and what'll work best. But for this year, there's already a bunch of challenges that people are going to face, and that's without the expiring LIHTC compliance periods or anything else. Like, it's hard to build interest rates. It's hard to build with this economic uncertainty. So we'll have to keep watch of housing affordability. And
I would guarantee that the picture's not going to get any better for your next recording. By your next recording.
Yeah, that is a guarantee. Nothing's.
This is more of a 2 years. Right. 2 years later on the Gray Report.
And that is 100% true, and that's something that we can look back to the Marcus and Millichap video. We're dealing with long-term trends, and along with these demographic trends, there are long-term trends of apartment supply that started during the Great Recession of like 2008, 2009. We stopped building new houses for like 10 years, and now we're just kind of starting to build a lot more of them, and we're maybe like a quarter, a third, maybe halfway through building what we need to build, but we are nowhere near close. We're nowhere close to getting enough of it. So a big struggle ahead, and that's going to mean that houses likely increase in value short of a recession, but that's not to say that affordability is a complete wash. It's just affordability of home ownership. Because I just wanted to add this Moody's chart. I really like the chart because it shows a lot of in terms of like what is where rent to income is, where income growth is, and how home price growth, how those are all intersecting. So for the listeners, you see a red line representing rent to income, and it is increasing from a little bit over 24.5% in 2000. And now it is at 27.4% in, that's projected. Let's say maybe it's closer to 27% in right now in 2025. That's their projection. And then for home price growth, it's followed a lot more of a wild trajectory, but it is still growing positively, and it's been showing positive growth since mid 2022. And there was a huge spike in 2020. Ultimately, it is growing almost the same rate as job growth, which is growing at 4.1%. The big point that I wanted to make here is, number one, rent to income is continuing to go up. At least in this graph, it still shows a general increase of about 3%. Now, it's relatively little, but that's still like that still puts the lie a little bit to all the stories of decreasing rent to income growth. Yeah, if you set the pin at 2022, then you see a decline from like 29 to 27.4, but it does in general, the general trend here is an increase. Now, that's just the Moody's Analytics numbers, because I wanted to get another data source. If you do look at, and this only goes back to 2010, but RealPage, it shows a different story when it comes to rent-to-income ratio. Right now, we are at the same rent-to-income ratio. And this is for 2024. Again, 22.5 is the rent-to-income ratio that RealPage says. That's the same as it was in 2012. Meanwhile, the median home price-to-income ratio is increasing from 4.5 to 5.3. So a lot more home price growth, a lot slower, but still maybe it's possible that it does increase rent to income growth. And I think that I believe that in other sources here, the home payments, the monthly home payments, they're really outpacing, by an enormous amount. They're outpacing rent. So we've seen that flat rent growth line and the really sharp upward turn of the home income, of the monthly mortgage payment or monthly home payment line. So that's just another flavor to add. as much as rental housing has become more expensive, I think that renters have enjoyed a couple years of slow rent growth, low, sometimes even negative, and rent to income ratios have fallen as a result. Meanwhile, income growth has been positive as well. So we've seen, because of this positive income growth and the lower rent growth, we're getting We're getting some cheaper rental housing. People are people can breathe a little bit easier. I'm not sure how long that's going to continue. I think a lot is going to depend on the overall economic environment.
I'm quite confident that this will follow your what we talked about in the last segment of this isn't going to be a by the next episode problem.
Yeah.
This will be more of let's have this gray report episode in 2 years and see where things are at.
Yeah.
Carmel and
Carmel, Indianapolis, a famous suburb of Indianapolis.
the Carmel, Zionsville, that kind of area.
Zionsville, another suburb of Indianapolis. I'm just sharing for our national listeners.
That always, from what it appears, has always been one of those markets where concessions were pretty rare, and now as a bunch of new supply has hit, you're now starting to see the concessions. And I'd have to go get the specific rent numbers to speak better to it, but there's when you kind of mentioned that softening thing, there's a part where you're seeing that where concessions are being offered, or there's some flexibility that otherwise was not being offered, and to parts of the country where they've seen rapid population growth because of the new supply, or at least where they've had new supply. Same thing. You're starting to see the concession growth, or you're starting to see the rent growth either dip back a little bit, or just flatline, because it's like, well, okay, I could move to this apartment complex and get $2,000 off my first few months, or 3 free months, or whatever. I mean, I know, at least in kind of the downtown Nashville area, that was a situation that a lot of these apartment complexes were competing on each other for. Is it really came down to if the renter was willing to move to experience those.
That's interesting. A lot of hopping.
But I mean, I foresee that trend going away in 2 years. I mean, if supply tapers off, it's going to continue.
We're talking about long term, but then supply trends are becoming more and more short term, and I think that's worth mentioning. Also, I wanted to add that the things that happen to lower, so it could be the case where rents and home prices go down because of people are bummed out about the economy. That leads to lower demand across the board. But there are these kind of shorter term trends that could be felt in a submarket or a market where supply just is, you're either swamped with supply, or now maybe you're under supply, or things are coming to a balance, and that happens a little more quickly than the demographic trends that we were talking about.
Well, that's what I was kind of hoping to speak to a little bit with some of the stuff regarding Carmel, of not necessarily always dealing with, some of these things are not always dealing with rent growth. It's just like you're getting that concession, or you're getting that 1 free month or whatever.
Yeah, that's a good point.
That you otherwise were not going to see in more of a robust.
And it doesn't necessarily show up in the rent growth numbers if you're putting that concession on there.
No, I mean, somebody signs a lease that's 4% above. It's 4% above. You'll definitely see it on when you're going to underwrite these properties, in an elevated concession amount that otherwise wouldn't be there. But I just mean that more so in the sense that people can look at a market and say, okay, well, rent growth has either it's been the same, or it's ticked up a little bit, or whatever. But there are some markets where even the new supply it's not enough to fully pull the rent growth down, but you're going to start to see the concessions, or just some things.
That would be interesting to get a figure of concessions as a percentage of annual rent. So, like, if you're given 3 months free, then that concessions would be 25%, right, of the annual rent. And that would just be interesting to take a look at and see, because I think that concessions, it could be free cable, or it could be 3 free months. There's some that are really valuable and some that aren't valuable, and just to say, oh yeah, there's a lot of concessions there, it seems to be a broad group of things that has a lot of variability within it.
Well, some of it is also just, these new construction properties needing to hit occupancy so they can get on to the next. Because, I mean, if they're merchant developers, they really don't want to be holding on to this long. And they know that they're not going to get the purchase price they're hoping for if it's not stabilized. So if they can throw in an elevated concession amount to get occupancy to 90% and above, it might not help them on the kind of T12 cap rate basis that they're going for, but at the same time, you're at 90 to 95%
Yeah.
occupancy, and you can begin this. You can kind of begin to move forward on your business plan. Whereas we've seen some people, they don't really shake out of it, and then they're trying to sell a property for. I shouldn't say they're trying to sell it for dramatically less, but all of a sudden your financing options and kind of your proceeds are going to be a little bit different when you're at. I shouldn't say kind of. They are going to be different if you're at 80 to 85% occupied than if you're 90 to 95.
Yeah, and some are facing some trouble. Maybe you could call it distress.
Look at that segment.
That's so beautiful. Let me get back to my notes here. So it says multifamily distress volumes hit 12-year high. My first bullet point is, what are we really even waiting for? I think that a lot of people got excited about distress the minute that interest rates started going up in 2022. They started looking forward to that. Unfortunately, we had, well, or fortunately, depending on who you are, instead of this kind of bonanza of distress and cheap properties for everyone, no one loses, we had low sales volumes and prices that really didn't go down as much as maybe people thought would. It just was not a landscape where you were scooping up deals left, after, right. That being said, there is a growing amount of loan delinquencies and some interesting trends that they highlight here in this Cred IQ report. I use this. I think that the delinquency trends here are a little bit stronger than the loan loss trends. So here are the delinquency trends. You can see how it's going up. So there was a lot of delinquencies in March of 2010, and then it slowly tapered to really a low point right before the pandemic, and now they're increasing again.
Did something happen around 07, 08, 09, 10?
Don't worry about it. Read it in history books. It's the Great Recession, sorry. Great Recession, Great Financial Crisis, the housing crisis, all of those. It resulted in some difficulties. You can clearly see in this chart, and that would be my the only thing I'd be curious about is how much is what the landscape of loan delinquencies looked like before 2007. But that's fine. I still really, I think that the data they have here is still really helpful. And then you see the multifamily loan loss trends are, they're less pronounced now, but they are still going up. And what I wanted to illustrate here was not necessarily the line graph, but this table of data that they have here for the loan. So it's multifamily delinquent loan balance trends. Right now, the number is $6.11 billion in delinquent loans. And if you go back in time, so now we're 2019, you have to go all the way back to the beginning, Q1 of 2012, before you get back to 6.69 billion. And 2012 was the tail end of the delinquent loans associated with the Great Financial Crisis, the fallout there. Mm-hmm. And that's also important to note, like I said, these long-term trends. That spike lasted several years. It was 2009, 2010, 2011, and 2012. Really, that was a long hill. Like, that took several years, and it didn't exactly go up and then go back down. That was long. Now, I don't know if this is a blip or not, but it does seem like we are building towards something again. So the low point is and they color code this to make it really nice. The colors are green for very low loan losses, yellow for medium, and then we go to orange and red for the high loan losses. Now, right now, so in 2015 to 2019, we were in that green period. Everything was nice. We were kind of at the low point when it comes to loan losses, and then it steadily got a little more yellow. In 2020, got a little more yellow, and 2021, the loan losses increased. So we're talking the low point, 1.09 billion, maybe 0.96 billion, let's say about that. And now in 2 years, so 2019, sorry, let's restart here. 2019, 0.95 billion. That's pretty low. But then 2 years later, we are getting into 2.2 billion. So that's double. And now 2023, we're getting to 3.42 billion, and 2024, 3.6, 5.6, 6.1. It seems like these numbers are getting higher. Am I going crazy? Are they not? Are these numbers going to go right back down, or are we seeing the start of another long-term trend towards increasing loan delinquencies?
I don't know how long term, but no, I don't think it's going to be an overnight situation where
Yeah.
these loans become where there's less delinquency. But what is difficult for a lot of operators, and I think many to their frustration, is that there are plenty of people that would be in the delinquent or underperforming category. I mean, there are plenty of operators that did not know what they were doing, and they bought at a bad basis,
Yeah.
or they had a bad
Used
business
floating rate
plan.
loans, and now their
Right.
interest rates are high, and they also may not be the best at operating. So
But at the same time, there are plenty of people that would be in the underperforming or delinquent camp where they know how to run a property. They executed their value add plans perfect.
Yeah.
They got the rent growth. They did like everything on their pro forma, their underwriting that they planned to do, that they said they were going to do. They did. The debt just went up on them.
yeah. Things that are happening through the fault of people and through no fault of their own.
Right.
Yeah.
And I think, when we were at the NIAP event 2 or 3 weeks ago, George and Cam at CBRE highlighted a property that they were that they had sold or were selling in Iowa that faced, that faced
Some
was in that
borrowing
exact situation where they
they were doing it right, but yeah.
and they faced a debt situation. And then there's also plenty of people that just did not know what they were doing across the board and forecasted 30% rent growth. And so, I don't think that that's going to go away, because there are plenty of people that are, as we kind of highlighted at the top of the show, there's still plenty of people that are like, hey, if rates go down, there's a way out of this, and there's the potential for what people seem to think is kind of this extended pretend period.
Yeah, I'm curious about. So this is outstanding delinquent loan balance this is CMBS loans as measured by or as recorded by by CoStar. I'm sure they pulled their data from somewhere. So you can see that there is a kind of spike in the end of 2024. Maybe it's going down now. Now, this is all some estimates for when you get up to closer. However, it does look like it's rising. Now, they have it for the last 5 years. So, and if you go to back to Credit IQ, let's see, it seems like you're seeing the same thing. I mean, it does look like that same increase, and we'll have to see.
But it's also correlating to when people were purchasing these loans.
Yeah.
And especially doing short-term solutions in 2020 and 2021.
Yeah.
23,
so
24,
it's what you invest in.
were,
And sometimes it's where you invest. Sometimes it doesn't even matter where you invest. You can get caught on the wrong side of things. And that was what was interesting about this other article from Credit IQ, where it lists the top 50 markets by Credit IQ distress metrics. This report looks at the top 50 markets that are maybe the most technically or emotionally distressed. They have, this is delinquent or specially serviced loans. So we can pull up let's look it up. What does it mean to be for a property to be distressed? I made a little bit of spelling errors there, but here we go. And let's let the AI answer. It's a distressed property is facing financial or physical challenges. No, I'm looking for a technical definition. That's fine. I've got to move forward. Let's talk to you, Addison. You're a person. And what do you see? What do you see when you look at this list of 50 markets that are ranked by the amount of delinquent or specially serviced loans? The distressed rate on the top one is 49.7, and on the bottom one is 0. So big range here. Is there anything that you pulled out here? Anything you thought was kind of interesting?
Yeah, one of the things that has been kind of top of mind, and it seems like it's been the narrative of the last 2 or 3 years, is a lot of your Sun Belt markets like Phoenix, Miami, Nashville, Dallas. They've some would say are overbuilt, but that's where a lot of supplies happen. It's where a lot of people went to buy. They bought at high bases, I should say.
I want to throw. I want to stop you just right now. I want to define distress as you can't pay your loan anymore.
Go for it. Yeah.
All right, that's where I would throw. I'm sorry. I realized that I did not submit my definition there, so I just wanted to say that before. Okay.
What really stands out to me is the kind of the markets where you would think, all right, this probably attracted some developers that probably went into a market more on a field basis than anything. They surprisingly don't really have as much of the delinquency issues as one would think. And to go back to what I had mentioned on the previous topic or on the previous page, where people performed just fine and they still had trouble. You would also think that there are plenty of people in these markets in Phoenix or what have you, where based on kind of the demand and how many transactions and everything was going on, you would think that the heightened supply and in some cases subdued or negative rent growth would have really caused issues. And at least by this, it does not appear
not at all
to have been the case. So that was the eye-opening. That was
just
more
how
of the
much
eye-opening thing.
different regions are kind of spread out all across here. There doesn't seem to be a hugely clear pattern here of like you'd think maybe all the overbuilt Sunbelt markets would be distressed, but they're not at all. The number one is Minneapolis, which may not be a surprise to some people because they actually have built a lot in Minneapolis, which has reduced rent growth. But that's 49.7%. And Providence, I have not heard a similar narrative in Providence, but that's 45.4% of delinquent or specially serviced loans. So Minneapolis, Providence, these are in the Midwest. Chicago, 28.9% delinquent. Now you go back down to the very low ones. You already mentioned Phoenix, which is only 4.6% delinquent. Where is it? Austin, 3.9%. Now that is almost synonymous with oversupplied, low rent growth market, but not delinquent. They're still paying their loans. And same thing with Raleigh. However, and this is super weird too. So it's not just that all the Sunbelts are doing great because let's go over to Charlotte. That's actually 21.9% delinquent. Indianapolis, Midwest, healthy, great, stable rent growth, 17.1% delinquent. We've got to look around and see if there's some distressed opportunities in our own backyard.
Louisville's at 12%, down at 24%.
Yeah, so the huge. I was surprised not only by the range. Again, we're talking 49.7% from Minneapolis versus 0% for Salt Lake City. But the fact that some of these, a lot of these Midwestern markets are higher than you'd think, or at least they're just dispersed throughout the entire list. Cincinnati is at 16.8, but on the other hand, Columbus is at 1.3. Kansas City is where is that? Kansas City is pretty low. Wait, what did I have here? Kansas City 2.6%, but Milwaukee's at 23%. So wherever you shake it, I would be super interested to see why, what the reason for all of this is. But that's going to involve probably a little bit more complicated research. I'll have to contact some experts at Credit IQ, particularly the author of this, who is Michael Haas. I'll have to see if he can sort out the reasons why. I can't find a regional pattern here. I always like it when there's a regional pattern. I especially like it when it shows how great Midwest is, and I can't find that here.
No, the only thing that I can think of, and this is just thinking out loud, is I don't really have concrete numbers to say it either is or definitely is not this. If you're in a market where a lot of people developed and it was done by merchant builders where they were able to build, get the property up fast, and then sell, enough of those deals could have taken place where some people saw, okay, I think this is where floating rate debt picture is going to happen. They got on fixed rate enough. If you have the transaction volume going on, you either have people that aren't yet delinquent, or they saw the writing on the wall and got themselves on a debt structure that they were going to be able to manage. Whereas some markets where maybe the development and the new supply didn't catch up. Yeah. But
that's interesting.
I don't know. I mean, Minneapolis got to it on development and they're high up there, and some of these other markets aren't. So that kind of negates everything I just.
I know there's
said,
no
but
party.
I-
I'm gonna have to
I-
look and see what and if you know, and if you're a listener that knows, leave a comment here on the video or on the podcast. I'd love to learn here. But it is I think you should start looking at some of these with high numbers, and maybe we'll get a deal because they're not necessarily correlated with the strength of the market fundamentals. There are some here where it's perfect, like Indianapolis, for instance. The supply and demand story is really positive, and so are a lot of these Midwestern markets. Even like Chicago's not doing too bad either, but they're high on the delinquency. So maybe that means there's a deal just around the corner that you'll find for us, Addison. That's what your job is. That's not my job. That's not my job. My job is to congratulate you when you do it, and let's get to it, Addison. All right. Thank you so much for joining the Gray Report. Addison is going to find us a deal in the next 30 minutes, and we'll have updates on that. But we'll see you next week. Thank you so much for staying with us. I'll see you next week.